So what is binomial tree model? Binomial tree model is basically an option pricing methodology which will help you understand how option prices move in real time in the real world. So this movement of the option prices is modeled using the binomial tree model. So what are the characteristics of this binomial tree model? First of all, this binomial tree model is very simple and it is very intuitive. Once you know how the binomial tree model works, you will definitely understand how the option prices are modeled and how the option prices behave in real world. Second important aspect is it is a step-by-step approach. We will understand this. See, binomial tree model always gives two branches. One branch is one probability and the another branch is the probability of an up move and a probability of a down move. So in real world also, the market can either move up or it can move down. By which percentage the market move down and what is the probability of the market moving up or down is basically a probabilistic in nature, and we have to understand that. So binomial tree model will help you understand this movement of the option prices through a step-by-step approach. You can have either a simple one period model or we can have multi-period model trees also. So the pricing which will be determined using the binomial tree model is based on the principle of risk neutral modeling. So risk neutral is there will be no arbitrage opportunities and the interest rate will be the risk-free interest rate which will be equal to the interest rate of the any treasury bonds of the RBI. Basically, options are used by hedgers for the purpose of hedging their portfolios. Speculators who uses options are very less in the real world. Basically, options are used for the purpose of hedging the portfolio by portfolio managers, mutual funds, pension funds, and others. Binomial tree model basically help you understand the time value of money in the derivative market, because everything when we derive the binomial tree model, we try to utilize the present value of the future option prices. That is why time value of money concept becomes important in understanding the binomial tree model. So what exactly is a binomial tree? See, it is first of all a discrete price movement model. What is discrete price movement? The price movement is shown in the binomial tree as movement of the price in very small steps. Okay, so it is basically a graphical representation and it represents the possible future price of an underlying asset at discrete time interval. So if you are taking any underlying asset, what will be the path traced by the price of that underlying asset? That will be represented graphically using the binomial tree. So we know that the future price of an underlying asset can move either up or it can move down. That is why we are using basically binomial tree. So binomial, why are we using this? Because at each node or the time step which we are going to consider, the price can have only two positions to move. Either it can move up or it can move down by any predetermined price patterns based on the predetermined factors. Secondly, binomial tree has a branching structure. See, each node always branches into exactly two possible outcomes. At every point, if we say at point 0, at time t0, if the price of an underlying either goes up or goes down, it means it can branch up or branch down. Once it branches up or branches down, again there will be two possibilities. In for the next time interval, the price can either move up or can move down. So that is why we are saying that each node branches into exactly two possible outcomes. So here a tree like structure is created, so that expands as the time progresses. We should understand that this branching methodology captures the uncertainty in the asset price movements, but at the same time it will help you maintain the mathematical traceability of the price of the underlying. So what is the primary application? So the primary application of the binomial tree is option pricing. See, option pricing are basically of two type, as we know, American style and the European style. But binomial tree is basically used for American style, where the early exercise of the option is possible. We know that in European style option, the option can be only exercised at the closure of the time of the contract. So who pioneered the binomial tree approach? The binomial tree approach was pioneered by Cox, Ross and Rubinstein in 1979. So why should we use binomial trees? First of all, it gives flexibility for complex option pricing. See, it will help you analyze American style options also, because American style option permits you for early exercise of the option compared to the European price option, where you have to exercise is possible only at the end of the contract. So binomial tree will help you evaluate the what should be the exercise strategy when the price reaches each node. So here you compare the continuing value of the option price with the immediate exercise value. So whatever is the maximum out of these two values, we will take that value. If the continuation value is higher than the exercise value, we will continue with the option, or if the exercise value is higher, then we will immediately exercise the option. So it is a step by step approach, and it will give you a very clear graphical representation how the option prices change over a period of time. And finally, binomial tree is basically an approximation of the continuous process which is used in the Black-Scholes model. Okay. Any increase in the time steps of the binomial tree will ultimately converge to the continuous time model of Black-Scholes model. So binomial tree basically acts as a bridge between the discrete model and the continuous model in finance. Binomial tree will also handles path dependent options like barriers and lookbacks. We will discuss what is a barrier option and what is a lookback option in the future slides. We know that most of the underlying assets may give dividends periodically. So this binomial tree will help you accommodate these dividend payments very easily in its mathematical model. So binomial tree will also help you provide insights into hedging parameters like Greeks. So what is a hedging parameter? We should understand hedging is basically done in a direction opposite to the direction of the movement of the underlying. It means, suppose if you are long on the underlying, then the hedging will be done on the short side. So but how much hedging of the option should be done, that is determined by a option Greek called as delta. So delta is determined using the binomial tree mathematical concept also. We will see how delta is determined using the binomial tree concept, and this delta has is very dynamic in nature, As the price of the underlying keeps changing, the delta will also keep changing. Binomial tree is basically, you can use it for scenario analysis and for stress testing also. You should know what is a scenario analysis and what is stress testing. We are not going to discuss the concept of scenario analysis and stress testing here. Binomial tree basically is computationally very efficient for many applications. I mean, we can when we do the problems, you will come to know computationally it's very simple and it is very efficient. It is not that complex compared to the Black-Scholes model. Black-Scholes model formulas are quite complex, whereas binomial tree model formulas are very simple and efficient. See, we should understand that any mathematical model uh, will have certain advantages and disadvantages. If a mathematical model is highly accurate, but at the same time it is extremely complex, then that mathematical model will be of no use. However, if a mathematical model is slightly less accurate, let us say instead of being 100% accurate, if the mathematical model is even 90% accurate, but at the same time the mathematical formulas and mathematics involved is very simple to understand and calculate, then that mathematical model is preferred more than a mathematical model which is 100% efficient but it is highly complex to calculate within a given time frame. So that is why binomial tree takes precedence over other option pricing models, because it is simple, it is efficient, and it will give you accuracy good enough for you to take a informed decision while using options. So let us see what are the key assumptions of the binomial model. See, every mathematical model, before it is being derived, there will be certain assumptions. There are no mathematical models without assumptions. The assumptions which are done in the mathematical model is to make the calculation of the mathematics, the concept simple rather than making it more complex. So first of all, the first assumption is there is no arbitrage opportunity. What is an arbitrage opportunity? If there is an underlying and the price of the underlying is different in two different markets, then traders will generally use this price difference to their advantage to get riskless profit. So that is called as arbitrage. If you want to know more about arbitrage, there are many videos of mine where I have explained arbitrage with mathematical examples and real life problems. So you can just go and see those videos where you will get a better understanding of how arbitrage is done. No arbitrage means you cannot get riskless profit. It means you have to have some amount of risk in order to get benefit or profit from any financial model. It is basically assume risk neutral valuation. It means that the interest rate which is being decided is risk free interest rate, like the interest rate provided by a GSEC. That is a risk free interest rate. So that is why binomial tree model, when we calculate the rate of return, the rate of return will be a risk free rate of return, which is nothing but the rate of return of a GSEC. We will understand what is adjusted probabilities for pricing. We will see when we start discussing those models of the binomial tree. So here we have a discrete time interval, which we have already explained, that binomial model works on the discrete time model. And while deciding discrete time model, there the tree recombines from up and down and from down to up. We will discuss it in when a problem is solved in this. So it will have finite steps with recombining nodes, and it assumes that the markets are perfect. When is the markets are considered to be perfect? A market is considered to be perfect when there are no interest rate discrepancy between borrowing and lending. There will be no brokerages while dealing in the market. So these are some of the components of being in a perfect market, and all the market participants are aware of the rate of return and the risk free rate available in the market. So let us understand the key assumptions of the binomial model. So the binomial model is basically built on the principle of no arbitrage, which we have discussed. And what is the practical application? So this assumption of no arbitrage will help us to derive a unique option price that is consistent with the absence of arbitrage opportunities in the market. However, the binomial tree sometimes assume constant volatility, but constant volatility is not possible in a market. So that seems to be a little bit basically too restrictive a model. But we have to go with this model as it has already been taken into consideration. Here the market also, the model also assumes that the market is complete and the market is perfect. However, in real world, the market cannot be perfect. Taxes will be there, brokerages will be there, and all the people will not be uniformly informed about the market structure. So let us understand one period model setup for the binomial tree. Let us understand that the starting price or the current price of an underlying is S0. So this price of S0 can either move up by a small amount u, that is small u. So it will move up in small u percentage, means it will be S0 into u, and the probability of moving up is q, or the price can move down to S0D with a probability of move 1 minus q. So we should know the probability of up move q plus the probability of down move 1 minus q will always equal 1. It means to say that the probability will always be 1. Probability of up move plus probability of down move should always equal 1. So here they are considering that the probability of the up move is q and the probability of down move is 1 minus q. So S0 is the current stock price, U is the up factor. Here the value of U should be always greater than 1 because we are considering the price is going to move up. So if for the purpose of the price is going to move up, then U should be either 1.05, 1.1 or 1.2. Then only the price will move up. Similarly, for D, the down factor should always be less than 1, because if we consider a down move of 0.9, it means S0 into 0.9 will be less than the S0. So the price is actually going down compared to the current price of S0. Q is the real world probability of up move. Okay, so basically these parameters define the possible stock prices which may take a particular path in a very oversimplified world. So this is a one period model setup. So let us see how does this one period model setup is done. Let us consider one long stock priced at S0. So how many quantity? Delta quantity. So we are having a long stock priced at S0 of quantity delta, and we have got one short option priced at F. So the price of the option is F, the price of the underlying is S0, and the quantity which we have purchased of the underlying is delta. So what is the time period of the option? The time period, this option lasts for a period of time T, capital T, where T can be 6 months, T can be 3 months, or T can be 1 year. So here we are considering two things. One, we are considering an underlying, and another we are considering an option which has been shorted. So we have gone long on the stock price with a quantity delta, and we have gone short on one option which is priced at F. So when we combine these two as a portfolio, then this portfolio should, you know, earn risk-free interest rate in a no arbitrage world. Since we have considered that there is no arbitrage, and since we have considered the interest rate is risk-free interest rate, then when we create a portfolio out of one long stock priced at S0 of quantity delta, that is S0 delta, and one short option priced at F, which is we have taken a short position. So S0 delta minus F should create a risk-free, earn a risk-free interest rate. Now we will consider up move of stock during time t. So we have already analyzed it. It will be S0 into U, where U is greater than 1, and down move will be during this period of time capital T is S0 into D, where D is less than 1. So the percentage up move is U minus 1. If U is greater than 1, so 1 minus U minus 1 will be the percentage move. Suppose if we take U being greater than 1 as 1.1. Okay, now U minus 1 will become 0.1. So 0.1 is the percentage up move. That is, the percentage up move will be 10%. I hope you understood. See, if we are considering U as greater than 1, and suppose if you assume U equal to 1.1, okay, then U minus 1 will be 1.1 minus 1. See, 1.1 minus 1 will be 0.1. So 0.1 is nothing but the percentage of up move. So 0.1 is nothing but 10% up move. Similarly, percentage down move is, since we are considering D as less than 1, so 1 minus D will become the percentage of down move. Okay, let us understand the one period model setup. See, as we have discussed, at the start of any contract, we will have a S0, which is the price of the underlying, and F, which is the price of the option. So the underlying price and the option price will only have two paths. The path one is the price may increase from S0 to S0 into U. We have already discussed the value of the U. U is always greater than 1. And the price of the option may go from F to FU. So we will use the convention FU for this. Similarly, the price of the underlying and option may go down. So by how much amount? It will go down by D. So S0 into D. D we have always discussed, it is less than 1. So the option value will go down to FD. So we have two paths. Either the price can go up and the price can go down. Now the value of the portfolio. So we are having a portfolio with both the underlying as well as an option, right? So we had taken a long position in the underlying, and we had taken a short position in the option. So after a point of time t, what is going to happen? As we have discussed, the price is 0 into delta. What is delta? Delta is the number of underlying which has been purchased by us, which we have gone long. And U is what? U is the up move which has happened here, minus FU. Why? The Because since we are short of in the option, so the short option, when the prices go up, the short option will lose money. So that is why we have to reduce that much amount from the total value of the underlying. So underlying has moved up by a quantity S0 delta U, and the option price has gone to another level called as FU. Now we have to reduce FU from this underlying price, because we are short on the option. So whenever the price moves up, if we are short on the option, we will lose money. That is why we are here reducing FU from this value. So what is FU? Fu is the value of the option price. So how are we going to find out the option price? It is the maximum of SU. What is SU? We know. Minus K. What is K? K is the strike price. So SU minus K, comma, or 0. So if SU minus K is positive, then Fu will be a positive value. But if the Su minus K is negative, it means if the value of Su is less than the strike price, in that case, then the value of the option will be 0, where K is the strike price. So value of portfolio after the down move after time t is similarly S0 into delta into D minus FD. So the two value will be equal, okay, when S0 delta U minus FU will be equal to S0 delta D minus FD, because the chances of moving up and chances of moving down equal probability we have taken as of now, so they should always equal. In case here the value of FD, that is the option, when the underlying price moves by D value, then it will be SD minus K of 0, that is max of SD minus K comma 0. So if we simplify this equation, it is so simple. So what are we doing? We are taking S0 and delta as the common factor, so it becomes S0 delta into U minus D, Fu minus D. So if you take it that way and you take out the delta, because you need delta now, so delta is what? Number of contracts to be shorted. So S0 minus U S0 U minus S0 D, which will be equal to Fu minus, and finally delta will be the Fu minus FD. What is Fu minus FD? Fu minus FD is change in the option price. Similarly, what is the denominator S0 U minus S0 D? It is the change in the price of the underlying. Since we have considered that the portfolio is riskless, hence it earns riskless return. What is riskless return? Riskless return is the return given by any government bond or GSEC. So delta is nothing but change in the option price divided by the change in the stock price. So now the present value of the portfolio which made an up move after time t. So we understood that the portfolio made some up move after a time t. But if we want to calculate what is the present value of that particular value after it moved after time t, is we have to use the continuously compounded formula to get the present value. So S0 delta U minus Fu is the value of the portfolio after time t when the portfolio has moved up. If we want to know the present value, we are going to multiply it by e to the power of minus small r. What is small r? Small r is the risk-free interest rate into capital T. Capital T is the time frame which we are considering for the time of the option. So what will be the cost of setting up of this portfolio? We knew initially we started off with a underlying at a price of S0 into delta, and we had gone short by one option. So S0 delta minus F is the cost of setting up of the portfolio. So the present value of the portfolio which we have calculated here should be equal to the cost of setting up of the portfolio. Why? Because we are assuming that if the portfolio has moved up by this much amount, its present value should be e to the power of minus small r into capital T. So what are we going to do now? We are going to equal S0 delta minus F to S0 delta U minus Fu into e to the power of minus RT. Now here you are going to get the price of the option at the initially. What should be the price of the option F, which is equal to S0 delta minus S0 delta U minus Fu into the e to the power of RT. So with this formula of F, we know that delta, this is fu minus fd divided by s0u minus s0d. We have just derived this equation. Okay, so this is the delta or the hedge ratio. This tells exactly how many shares we have to buy for each option sold if you want to create a risk free position. So if you want to create a risk free position, how many shares you have to buy whenever you have gone short in option against the underlying. So we are substituting the value of delta in this equation. Okay, so S0 into Fu minus Fd. So when you substitute and you simplify, you get this particular equation where we are considering P is equal to e to the power of RT minus D divided by U minus D. So if we consider P, that is the probability, as equal to e to the power of RT minus D divided by U minus D, then we will arrive at the price of the option F is equal to e to the power of minus RT into probability of up move, that is option price moving up FU, plus 1 minus P, the probability of FD, where FD is the price of the option moving down. So this is a very very simple substitution and simplification concept. We will not go, when if I put here this equation into P and 1 minus P, you will get this value back again. Okay, so this is the price of the option which we have calculated. So this formula can be used for calculating the price of an option if we know the risk free interest rate, the time period, the probability, and FU and FD. Where what is P? P is the risk neutral probability. So this equation, what is it giving? It is giving the expected value of the option in an up move and down move with a probability of P and 1 minus P. What is F? F is nothing but the value of the option at the start of the contract or start of the creation of the portfolio, which we created at the start. So when we created this portfolio, we assume that there are no arbitrage opportunities in the market. Understood? Now, let us take an example calculation. So let us consider a call option with the initial price as rupees 500. Now the up move U is always greater than 1. So 1.1 is the up move, and D, that is the down move, is 0.9, and K, what is K? K is the strike price, which is 510. See, if you want to understand the binomial tree model, first you should know what is a call option, what is a put option, what is strike price, what is the time frame of the option. All these things you should be aware, then only you will be able to understand the binomial tree in a better way. Here we are understanding what is K means. K is the strike price. It means strike price is the price at which you have taken, bought or sold an option, the price at which you have bought or sold an option. See, strike price may not be necessarily equal to the current market price at which you have taken the option. Okay, so stock prices will be S0 into U, which is nothing but 500 into 1.1. So the stock price has moved up to 550. The stock price, if it has to move down, so it will move down by 450. So option payoff will be what? S0U will be max of F0U minus K comma 0. So max of 550 minus 510 comma 0. So it is, the option payoff will be 40 after the time period capital T if the price moves up. If the price moves down, SD, the max of S0D minus K is nothing but 450 minus 510. So 450 minus 510 is negative. So the option, expire worthless. So you will not get any payoff from the option. The option will be worthless. Why it is worthless? Because here we are considering a call option, not a put option. whenever the price of the option goes above the strike price in a call option, then only you make profit. The option will pay off. That is why here, when the stock price is 550, 550 is greater than 510, it is greater than the strike price. So at the end of the contract, when the S0U is greater than K, that is the strike price of the call option, hence it is giving you a payoff of 40 rupees. However, when you have considered D is equal to 0.9, the stock price is 450. So 450 is nothing but it is less than the strike price at which you had taken the call option. Hence, the option will expire worthless. So what will be the deltas? So in order to hedge, what will be the delta? Delta is the change in the option price. The option price changed from, that is F, changed from 40 to minus 0. So 40 minus 0 here, 40 minus 0 divided by this change in the price of the underlying. It changed from 550 to 450. So delta is 0.4. Thus you have to buy 0.4 shares for each option that you are going to sell to create a perfectly hedged position. So if we consider 500, that is the probability of up move, into number of delta, this is delta, right? So we have calculated delta as 0.4. So 550 into 0.4 minus the option, that is F, it is 180. Similarly, even if you take the down move, 500 into 0.9, which is nothing but 450 into 0.4 minus 0, it will again come to 180. So this is a perfectly hedged portfolio because we have taken delta as 0.4 based on the change in the option price and change in the price of the underlying. So if the value of stock is 500 today, so if we consider the present value of the portfolio, which is valued at 180 after 3 months, see, we correct, right? See, the present value is valued at 180 after 3 months. Then we have E minus 0.1, 3 by 12. Why we are doing 3 by 12? Because it is after 3 months into 180. The value will be 175.5. So 200 minus F will be 175.5. So your value of the option at the start, that is the price of the option at the start, will be 24.5. So what are we doing here? If we take the price of the option at any point of time as 500, so 500 into delta, that is required to be hedged, minus the value of the portfolio should be equal to 200 minus F. Okay, so if we consider present value of the portfolio, which is valued at 180 after 3 months, so we are calculating the present value of 180 using continuous compounding at the risk-free interest rate of 0.1 into 3 by 12. So which is 175.5 will be the present value of the option. So the value of F will be 24.5. Here, this is the value of the portfolio. Okay, since you have hedged the portfolio with 0.4, whether the underlying price moves up or moves down, or the option price moves up or moves down, your portfolio value will remain same as 180 at the end of 3 months or time period capital T. So if we consider the present value of this portfolio, which is valued at 180 after 3 months, this is the value of the portfolio after 3 months. So we have to calculate the present value using the continuous compounding method. So you get 175.5. So here 500 into 0.4 is 200 minus F. This is 200 minus F. So this 200 minus F should be equal to the present value. That is the value of the portfolio at the start of the contract. This is the value of the portfolio at the start of the contract, should be equal to the value of the portfolio, present value of the portfolio after 3 months. So this is the present value of the portfolio after 3 months. Therefore, 200 minus F should be equal to 175.5, where F will become 24.5. So the value of the option at the start of the contract is 24.5. Now we will consider the probability considering 3-month option and risk-free rate as 10%. So e to the power of RT is nothing but E 0.312, which is 1.025, and D is equal to 0.9 and U is 1.1. So the P, the probability, is calculated using the formula E to the power of small r into capital T minus D divided by U minus D, which gives you the P is as 0.625. So the probability of up move is 0.625 and the probability of the down move is 1 minus 0.625, which is nothing but 0.375. So what is the formula? We have a formula for calculating the present, the value of the option at the start of the contract. What is that formula? That formula is equal to e to the power of minus small r into capital T into probability of the option into FU, the up move of the option price, plus 1 minus P into FD, which is the option price when the underlying loses its value by any particular amount. So F is equal to 0.975 into 0.625 into 40 plus 1 minus P into 0. So the value of F will be 24.3. So this value of 24.3 is same as the result which we calculated just before in our previous slide. So risk neutral probability, it is one of the most important concepts in financial mathematics. So what is risk neutral? It means very low risk or risk is neutral. Okay. Now, what does it mean? The probability P, which we have used in our previous, problems, it is not the actual real world probability of an up move. So, the probability P, which we have calculated using the formula, hence, the probability P, which we have calculated, is an arithmetic probability. It is not the real world probability. So, it is a mathematical construct, and this mathematical construct adjusts for risk premium. So, if you have seen the formula for the probability, it starts with e to the power of minus RT. So, it adjusts for the risk premium. What is the risk premium here? The risk premium is nothing but the risk-free interest rate, small r, which we have often discussed in our previous problems. So, risk neutral measure, it simplifies the pricing by allowing us to discount whatever the expected payoffs are there at the risk free rate. So how are we going to discount it? E to the power of minus small r into capital T, that is the discounting factor. So risk neutral probability help us discount the expected payoffs using the risk free rate. See, in a risk neutral world, every asset, whether it is an equity asset, bond asset, or any asset, all the assets are expected to earn the same risk-free rate, small r, whatever may be the risk of the asset. See, we know that equity asset will have a different risk profile, a bond has a different risk profile, real estate has a different risk profile. But in a risk neutral world, which is an ideal world, every asset is going to give a return which is equal to the risk-free rate. So, what are the assumptions made in the risk neutral measure? There are two assumptions. One is the expected return on the stock is the risk-free rate. What is the risk-free rate? Risk-free rate. The risk-free rate is small r. Small r can be the rate of interest given by a government GSEC. That can be considered as a risk-free interest rate. Now, the discount rate used is the risk-free rate. So, whenever you want to calculate the present value of all the expected payoffs, that discount rate which is used is going to be the risk-free rate. So with this basics into consideration, so how are we going to calculate the expected future payoff from the option? So here there are three words you have to be very careful. One is the expected. See, why we always use the expected means we do not know what is going to be the payoff whenever we are considering a option. So expected future payoff from an option is given by the formula. What is it? The probability of the option price moving up, that is P into FU, plus the probability of the future price moving down by an amount FD. So when we add both of them, that is the probability of an up move plus the probability of the down move, that will be the expected future payoff from the option. Similarly, we can calculate the expected payoff from the stock. See, expected payoff from the stock is basically calculated using the formula E, that is expected payoff of the stock ST is equal to probability of the stock moving up, that is small p, into S0, that is the stock price at the start of the contract, into U. U is greater than 1, so the percentage by which the S0 moves up, plus S0 into D. We know D is less than 1, so the percentage by which the stock price moves down, multiplied by the probability of the down move here and the probability of the up move here. So EST, when we rearrange it, we will get P into SO into U minus D plus S0 into D. So when we substitute the value of probability P, we know what is the value of the probability P, which we have already calculated. Then we get e to the power of ST is equal to S0 into the e to the power of small r into capital T. So what is this one? This is nothing but continuously compounded interest rate. That is, the stock price S0 is compounded continuously at an interest rate which is equivalent to the risk-free rate for a period of time capital T. So what is this? This is future value interest factor. So FVIF, that is future value interest factor, is your e to the power of small r into capital T, which is continuously compounded. So we conclude here that the expected payoff from the stock price is that the initial stock price S0 will grow continuously at the risk-free rate, which is equivalent to small r. So here we can conclude that in a risk-neutral world, we get the right price for a derivative in all worlds also. So let us apply the risk-neutral valuation to the pricing of the option derivative. So what are the probabilities of different outcomes in a neutral world? And then we calculate the expected payoff from the derivative. It is expected payoff. We have to be very careful. This is expected payoff from the derivative, and once you get the expected payoff, you are going to discount that payoff at the risk-free rate, which is nothing but the small r. So let us use an example. So we used an earlier example in our previous discussion. That is, if we say that the price of an option which was the price of an underlying purchased at rupees 500, that is S0 was 500, okay, and U was 1.1 and D was 0.9. So if we know that S0 into U will be 550, because 500 into U we have considered as 1.1, so 500 into 1.1 will be 550. So P is nothing but the probability of the underlying value moving from 500 to 550. Similarly, D is 0.9. So when we multiply 500 into D, that is 0.9, that is the down move which is going to happen. So it will be 450, and 1 minus P is the probability that the underlying stock price S0 move from 500 to 450. So this is the calculation which we did, that in case the price moves up 550 and the probability of up move is P, or plus the initial stock price, that is the underlying price, move from 500 to 450 and its probability is 1 minus P, that should be equal to the stock price S0 500 moving by a constant factor of 0.1, that is risk-free interest rate of 10% for a period of capital T, which is 3 months. In that problem we have considered T as 3 months. So 3 months is nothing but 3 by 12, it is nothing but it is 0.25 years. So expected payoff from the underlying stock price S at T. What is capital T? Capital T is the termination of the option contract. That will be equal to P into S0 into U plus S0 into D into 1 minus P. That is what we have done here. So when we simplify this equation, we get the value of P as 0.6275. If we tally this, the same thing will come, whatever we discussed in our previous problem, in our previous discussion. We are calculating the probability based upon the value of the risk premium, which is 10% in our case. Hence, the P is based upon the risk premium or the risk-free rate. Now, we know P is equal to 0.625 and 1 minus P is 0.375. So the expected value of the option after 3 months will be what? 0.625 into 40 plus 0.375 into 0, which will be equal to 25. So we should be wondering, where did we get this 40 and 0? So the option payoff S0U at the first step of the iteration will be nothing but maximum of S0U minus K. What is K? K is the strike price, which was 510 rupees. So we are calculating the option payoff whenever there is an up move equal to U, that is 1.1. It will be maximum of S0U. S0 is U is 550 minus K. K was strike price was 510 comma 0. So 40 comma 0. What is the maximum? 40 is the maximum. So maximum of 550 minus 510 comma 0. So this is 40. So the option payoff at S0U will be 40, and the option payoff at S0D is max of S0D minus K comma 0. Here S0D is maximum of 450 minus 510 comma 0. So 0 will be higher than, because this is going to give you a negative value. So the option payoff will be 0. That is how you have got FU will be 40, that is the option payoff FU will be 40, and FD will be 0. So that is why we have. So the probability of option value becoming 40 is 0.625 plus the probability of option value becoming 0 is 0.375. So we are taking the weighted average of the probabilities. So you will get the value as 25. Now the present value of expected value of the option is therefore, this is the value. 25 is nothing but this is the expected value of the option, which is going to be there after 3 months. So now we want to know what is the value of this 25 today. So how do we know the value of the 25 today? We are going to calculate the present value of 25. How do we calculate the present value of 25? You continuously compound, that is E minus 0.3. Why minus? You are calculating the present value. You are not calculating the future value. So when you calculate the present value, the risk-free interest rate becomes negative. So minus 0.3 into 0.25, which is nothing but 24.3. Actually, it is not 0.3, it is 0.1 into 0.25, which is nothing but 24.3. So this 24.3 value, if you remember, it is the same value which we calculated using the arbitrage theory in our previous slide. Now let us understand the multi-period binomial tree model. So one period model introduces the fundamental principle of option pricing. Okay. Now, however, in case of real world, it will not be a one-step binomial tree. It will be a very step binomial tree with longer, option taken for longer time horizons. So in order to handle the options for longer time horizon, we need multi-period binomial trees. See, multi-period binomial tree is a better approximation of continuous price process, which we will discuss in our next video. That is, the Black-Scholes model is the continuous price process, and it will generally give you an accurate option valuation. So how do we do it? We construct multi-period trees using the basic principle of single model binomial tree. And then we develop the backward induction algorithm for pricing. See, don't go by this backward induction algorithm and all that. These are all very big words, but it is very simple to calculate. We will discuss that. And then we are going to establish the connection between the discrete binomial model and continuous time models, which is nothing but the Black-Scholes model. Now, in order to build multi-step, we need time discretization. That means small time steps. So how do we get the small time step? If we divide the maturity of an option, suppose let us assume that the option has a maturity of capital T. The capital T can be 3 months, 6 months, 1 year, whatever. So if we divide this into n equal parts, small n equal parts, so each of length h, so h will be equal to total life of the option divided by the n equal parts. That is, you are discretizing, you are taking small intervals. N are small intervals, so that is, each interval length will be equal to capital T divided by small n. So this will create a framework where smaller step sizes will lead to greater accuracy, because the smaller is the step size, you will do more and more calculation, and you will move towards the continuous Black-Scholes model, which is a continuous process of calculating the option price. So here in the binomial tree model, at each node the stock can either move up or move down. It can move up by a factor u, or it can move down by a factor d. So after I steps, I may be 5, 10, 3, 4, there are I plus 1 possible stock price levels. Very simple logic. So whenever there is I steps, so there will be I plus 1 possible stock price levels. Now what is recombining property? See, recombining property help in ensuring that the binomial tree model will not grow exponentially, but it will grow linearly, because every up move followed by a down move is contested by a down move followed by an up move. We will see that in the binomial tree problem when we solve how an up move and a down move will combine, so that it will give a linear binomial tree rather than an exponential binomial tree. So this recombining property, what does it do? It will help to keep the number of nodes manageable. That's why what I am saying. So it will convert the binomial tree into a linear model rather than an exponential model. So let us understand this with the help of this graphics. See, in binomial tree model, understanding graphics is very, very important. So here we start with the basic underlying price as S0 and the option price as F. So After some period of time, the option price may become S0 into U, where U is greater than 1, and the option price may become FU, or the price may move down into S0 into D, where D is less than 1, and the option price may become FD. Now, at this step level, now this for the next level, for the next time interval, this S0 will again get multiplied by U. So it becomes S0 into U square, and the option price will become FU into U. But however, when this S0 into U now has to come down and become S0 into U into D. So what will happen if the option price here S0, it will, suppose if U is 1.1 and D is 0.9, then S0 will get multiplied by 1.1 into 0.9. Here S0 will get multiplied by 1.1 into 1.1. And here this one, at this particular node, there are again two possibilities. The stock price can move up and become, when it moves up, it will move up by value U. So it will be SD into U, no, S0 into D into U. And when it moves down, it is already S0D, another D will get multiplied, so it becomes S0 into D square divided S0 into D square, and the option price will become FDD. Here what will be the option price? The option price will be F into UD. So here in multi-period model, the time period is considered as delta T rather than the capital T. In single step model, we considered, since there was only one step, so we considered time period as equal to capital T. But here in this case, we have to consider the time step as equal to delta T. So we have discussed that at each node, and these are the nodes, okay? This is a node, this is a node, this is a node. So at each node, the stock can either move up or it can move down. Here also it can move up or move down. So what is the factor it can move up? By U, or factor it can move down is D. After I steps, there are I plus 1 possible stock price level. Step 1, step 2. How many possible stock prices are there? 1, 2 and 3. That's what they are saying. Now, the value of the option at the start of the contract F is given by the formula e to the power of minus small r into delta T. We are not considering capital T here because we are taking small time steps. That's why this has become delta T into the probability of up move into FU, that is the option price after time step 1 FU, plus 1 minus P into FD, that is the option price after time step 1. Now we know that small p is equal to e to the power of RT minus D divided by U minus D. This is standard. So the value of FU will be e to the power of minus R into delta T. Simple, no? Instead of here FU, it becomes FUU, and here instead of FD, it becomes FDU. And similarly for FD, it will be e to the power of minus R delta T. Here instead of FUU, it becomes FUD, and here instead of FDU, it becomes FDD. If you see the tree, you will come to know how these values are coming. So the value of F will be same as what we have discussed here. So now if you substitute the value of FU and FD for a two-step model here, we know the value of FU here, we have calculated this, and we know the value of FD here. So all we are going to do is this whole value will get substituted here, and this whole value will get substituted here. So what are we going to get? We are going to get this equation F is equal to, that is the price of the option at the start of the contract will be equal to e to the power of minus 2 small r into delta T. So P square FUU plus 2P into 1 minus P FUD plus 1 minus P whole square FDD. Okay. Now where P square, 2p into 1 minus p into 1 minus p whole square are all probabilities of the upper, middle and lower final nodes. Quite understandable, right? So this movement of the option price can be generalized to any nodes with any time interval. If we calculate that, so suppose if we consider instead of 2 time steps, if we consider 3-step tree, then S33, that is the final value of the underlying after 3 iterations, it will be S0 into U cube, where there will be 3 up moves. S32, that is there will be 3 up moves and one down move. Though S0 into U square into D, there will be 3 up moves, 2 up move and 1 down move. And S31, that which will be equal to S0 into U D square, where there will be 1 up move and 2 down moves. And finally S30, S0 D cube is nothing but there will be 3 down moves. So we have S33 where there will be 3 up moves, S30 where there will be 3 down moves, S32 where there will be 2 up move and 1 down move, S31 where there will be 1 up move and 2 down moves. Now let us understand what is backward induction algorithm. So backward induction is a very important concept while calculating the option price using multi-step binomial tree. It has got 3 components. One is the terminal payoffs. So what are we going to do? First we are going to calculate option payoffs at each final node. Final node, that is the last node. If it is a 3-step process, then you will calculate the last node. What will be the terminal payoff of each option? Then we introduce the risk neutral valuation. So what we do at each earlier node, that is one node before, compute the option value as the discounted expected value of its successor nodes using risk neutral probability. Very simple. Whatever the value we get at the last node, so last but one node will the value of that will be nothing but you discount the value of the last node by a time frame equal to the difference between the time of the last node and last but one node. That is known as you compute the option value as the discounted expected value. You are discounting it to that time frame, that is previous time frame. And then we are going to do an early exercise check. We will see what is the formula for the early exercise check in the next slide. And then we have to iterate backward. So we have to keep repeating this process until we reach the main node, that is the starting node. Now let us understand the mathematical formula for backward induction algorithm. For European options are the options which can be exercised only at the end of the tenure of the contract. American options are those options which can be exercised even in the middle of the contract expiry time. So for European option, the backward induction formula is Cij. I and j are two variables which represents the position of a node. If I is equal to 0 and j is equal to 0, the position of the node will be 0, 0. Okay. So now if we say that Cij, which is nothing but the value of the option, it is written here, right? So the value of the option at C00 will be equal to, this is the present value, e to the power of minus r delta t. Minus r is the risk-free rate and delta t is a very small incremental time into the probability of up move into the option value at the next node. What is the next node? The next node is I plus 1. See, if we take I as 0 here, it becomes C11. Okay, C11 means the probability of the up move plus 1 minus probability P means the probability of the down move into the option value at the down move. So what is the position here? 1 comma 0. So the down move will be 1 comma 0 and the up move will be 1 comma 1. So on and so forth, we can get the value of the option at each node using this formula. This is for the European option. So if we consider American options, then we have to check for the early exercise value at each node. So what will be the early exercise value? Early exercise value is nothing but your EIJ. Okay. So now the option value at any node will be equal to the maximum of the early exercise value or the exercise value at the end of the contract or the exercise value at the next node. So EIJ is the immediate exercise value, and this portion E minus R into delta the delta T, the same portion which we have calculated here. So we will take the maximum of these two at any particular node. At a particular node, based on the European option formula, this is the European option formula, whatever the value is there and EIJ is the value of immediate exercise, we will take the maximum of these two. And what is P? P is risk neutral probability, because in risk neutral probability we are using the small r, which is the risk free interest rate, to calculate the probability value P. What is the how do we calculate P? P we calculate e to the power of r delta t minus d divided by u minus d. That is the formula. Now let us understand with the help of an example. So if we take K, which is the strike price, as 52, see, you should know what is a strike price. Strike price is the price at which an option contract is executed, whether it is a long contract or a short contract. Now here in this example, what are we considering? We are considering an European put option. So put option means short position, right? So so in European put option means the person who has taken this option is expecting the underlying to come down, not go up. So that is a put option. So the probability of up and down move is 20%. See what has happened? The probability of up move will be 20% and the probability of the down move will be 20%. When the contract was executed at S0, the price will be 50. That is S0 will be 50. This is the long position in the underlying, and one short position in the contract, that is the European put option, has been taken in order to cover this long position in the underlying. Now what will be the value of these options at various node levels? Let us understand. See, if we move up one value, if the option value moves up by 20%, because we have considered in the binomial theory that it will move in discrete movement will be there, discrete steps. So the steps considered here is 20% up move or 20% down move. So the first step should be 20% up move. So 50 into 1.2, 20% up move will be 60. So 50%, the value 50, 20% down move will be 8 5s are 40. So this will be 40. So the value of the underlying at S11, which is this node, will be 60 and S10 will be 40. Now, if we consider again from this particular node, one up move and one down move, that is what binomial theorem says. So again, we will multiply 60 by 1.2 and 60 by 0.8 to get the value S22 as 72 and S21 as 48. From this node, we have got 40. Now this node can move up or it can come down. So here we are combining property has executed. We have moved down from 60 by 20%, it became 48, and we have moved up from 40 by 20%, it became 48. So this is the combining property. So at S21 we have a value of 48 of the underlying. S is underlying value, right? Similarly, if we move down from 40 by 20%, so the value will become S20, which is 32. So now, since we have considered only two step option, step 1 and step 2, so these are the values of the option at the end of the two steps binomial tree. Now we have to calculate the value of the option at the end of the contract. Now let us consider the probability value. Now the value of the probability P is equal to, as I have explained, e to the power of R into T minus D divided by U minus D. So if we calculate it this way, the probability comes to 0.6282 and 1 minus P comes to 0.3718. Now the value of F, that is the value of the option based on the formula e to the power of minus R into delta T into P into Fu plus 1 minus P into Fd has to be calculated now. But if we want to calculate this, we need value of Fu and the value of Fd. So if we want to get the value of Fd and Fu, we have to calculate the terminal payoffs here. So what is the value of the terminal payoff of the option? The option value will be maximum of the strike price. Since we are in a put option, it will be maximum of strike price minus the value of the underlying at the end. That is, here it is S22. That is, S22 is the value we have to put here. So max of 52 minus 72 comma 0, either of them. Now here maximum of this 2 will be 0 because 52 minus 72 will be a negative value. So the value of the option at this particular node will be F22, or you can take P22. So it will be equal to 0. Now if we come here, if we are using the same formula, the terminal value of the option will be max of 52, that is the strike price, minus S21, which is 48, or 0, either of the two, whichever is greater. Here 52 minus 48 will be 4, so 4 will be greater. So the value of the option at this node will be P21, which will be equal to 4. You can take P22, you can take it as F22, you can take it as F21. I have considered the notation as P, you can take it as F also. Now S20 is equal to 32, so the max of this will be 20. So P20 or F20 will be equal to 20. Now we have to work back to get the value of the options at these particular nodes. Understood? Now how do we do that? This is calculated using the backward probability payoff. See, what is the backward probability payoff of this? The backward probability payoff is value of the up move, value of the option during the up move is P21 or F21 into the probability, which is 0.6282 plus the probability of down move, which is 20, that is the option value when there is the down move has happened, 20 into the probability of occurrence of 20, which is 0.3718. So for P10, when we move backward from here, we have e to the power of minus R delta T. This formula we are using here, okay, to calculate the value of this node, option value at this node. You have to understand this is the option value F, P, F10. So here instead of saying F, we are saying F10. What is the formula used? Backward probability payoff 0.95, that is e to the power of minus R into delta will be 0.95 into 0.628 into 4 plus 0.3718 into 20, which is equal to 9.45. And P11, what is this? P11 is nothing but F11. So F11 is calculated in the same phase where we calculate 0.6282 into 0, that is the value of option at this terminal is 0, plus 0.3718 into value of the option at this terminal is 4. So the value of P11 comes to 1.41. Now finally the value of P00 is nothing but P11, that is 1.41 into 0.6282 P plus 1 minus p is 0.3718 into 9.45. So the value of the option will come to 4.17. So the present value of the option price is 4.18. Why we say present value? Because while calculating the option, the first component e to the power of minus r delta t, e to the power of minus r delta t is nothing but your continuously compounded discounting factor. So if we use the another formula which we have already done in your previous lesson, f is equal to e to the power of minus 2r delta t into p square fuu. Fuu can be f22 plus 2p into 1 minus 1. Fud must be 210 plus 1 minus p whole square. Fdd is f 20. So if we put those values, see, e to the power of minus 2r delta t is 0.92, p square is nothing but 0.6282 square into fuu, the value at the end of the terminal at the top end, that is f22 will be 0, plus 2p into 0.62 into 1 minus p is nothing but 0.3718 into FUD is, that is 21, that will be, the value will be equal to 4 plus 0.3718 whole square into F20 will be 20. So even if we calculate using this formula, the answer is going to be 4.16 only. So this is how we are actually going to implement the formulas and the backward integration formula and the backward induction algorithms which we are going to use. This is how it is practically used in calculating the option values at each node in a binomial tree. See, here we have to understand there are only three parameters which are required to calculate the option value backwards. What are they? The up move component u, the down move component d, and the probability p. Okay, so once we know u and d, then with the help of risk-free rate r, we can calculate the value of p. How do we calculate value of p? P is equal to e to the power of r delta t minus d divided by u minus d. This is the formula. Now the standard deviation of the return in a short period of time is given by sigma, is always standard deviation, into square root of delta t, and variation is given by the formula sigma square into delta t. We will not go into the details of how we are going to derive it, because it is beyond the scope of this presentation. Now if x is the expected return of the stock, see, expected return is based on probability, expected, it is not confirmed. So if we take x as the expected return of the stock, so the variance of the stock is given by ex whole square, that is ex minus ex whole square. And now if p is the probability that stock will give a return u minus 1, and 1 minus p is the probability that stock will give a return of d minus 1, okay, and if the volatility is matched, if the volatility of the up move and down move is matched, then sigma square delta t will be equal to p into u minus 1. This is probability that it will give you a return of u minus 1 whole square, plus 1 minus p into d minus 1 whole square, minus p into u minus 1 plus 1 minus p into d minus 1 whole square. This is just a manipulation of the values. See, what are we doing? We are saying the probability of the up move at node number 2, we are multiplying u minus 1 whole square 2, and we are taking the node 1 minus p into d minus 1. What is d minus 1? The probability of down move, and we have taken the square of it. Instead of p, we are multiplying with 1 minus p, and finally we are subtracting the probability, that is the combining factor, p into u minus 1 plus 1 minus p into d minus 1 whole square. So if we substitute the value of p, which is what? E to the power of r delta t minus d divided by u minus d, we get the value of u, that is the probability of up move, is e to the power of sigma square root of delta t, and the probability of the down move d as e to the power of minus sigma square root of delta t. So what are we doing here? Here the upmove component is calculated using the volatility factor, that is sigma, instead of using it as a normal value by approximating 10% or 20%. Here we are saying the up move can happen with when we use continuously compounded. E is continuously compounded, right? Sigma volatility into square root of delta t, which is nothing but the small time steps of the move of the binomial tree. So here what they have done, they have ignored the higher powers of delta r square. Now let us consider the practical aspects of binomial tree model. See, in real world, the company may give dividends when we are holding an option. So in such cases, then we have to consider the effect of dividend on the option price. Okay, so any dividends will generally result in reduction in the option price. So dividend adjustments are very important when pricing options with underlying, whether it is stock or whether it is indices or whether it is exchange traded funds. So any, if we do not account for these dividend payments, there will be significant pricing errors in calculating the option prices. Now let us start with the continuous dividend yield model. As soon as you say yield, so the dividend will be expressed in percentage. So continuous dividend yield means now the dividend is being expressed in terms of percentage rather than in terms of actual amount, like 10 rupees or 15 rupees dividend. They are going to express it as 10% dividend, 5% dividend. So we know if we say the dividend yield of a stock is delta, okay, this will be a continuous factor because we are expressing it in terms of a percentage rather than in terms of discrete amount. So when we consider dividend yield, which is in a percentage component, then the stock price is going to grow at a reduced rate. Why? Because we are going to subtract the dividend yield from the risk-free interest rate, because since the dividend are being received, the stock price has to be subtracted by the amount of dividend which has been received, because you are going to pay that much less amount for the stock price. So suppose if you have paid a stock price of 100 rupees and after 2 months you get a 5 rupees dividend from the company, net you have paid only 95 rupees for the acquisition of the stock, because 100 rupees you paid, 5 rupees company gave back as dividend. So what is the net amount you paid for owning that stock? 95 rupees. That is what it is being said. That is why when they are considering the yield as a percentage, then it has to be reduced from the risk-free interest rate in order to get the present value accurately. So this value of R minus D is going to impact the risk neutral probability calculation and the expected growth of the stock price and the relationship between option prices and stock prices. So how are we going to adjust it? See, we are going to adjust it. It will have a direct impact on the probability component. Here e to the power of R minus delta into delta t minus d divided by u minus d. This is the only adjustment which are required to be made in order to include the effect of dividend on the option prices. So here this component e to the power of R minus delta dt, so this is going to reduce the continuous compounding factor by a percentage of delta. The backward induction formula will remain as it is, as we have discussed in our previous slides. Here we have to understand that the probability component will now take into consideration the dividend which has been paid by the underlying stock. Let us take a small example to understand how this formula works. If we consider a two-period binomial tree with the initial stock price as 1000 and the up move as 1.1, down move as 0.9, risk-free interest rate as 5%, and delta, that is the dividend yield, as 3%, and the discrete time move as 0.5 years. And what is K? K is the strike price. So here S0 and K are same. Though strike price is 1000, then adjusted risk neutral probability P will be e to the power of 0.05, that is 5%, minus 0.03 into 0.5. Why 0.5? Because delta T we have to take into consideration, that is 0.5, minus D, which is 0.9, divided by 1.1 minus 0.9, which will be equal to 0.55. If we remove this 0.03, that is dividend component, then the probability will be 0.63 as we calculated in our previous slide. Now the probability is 0.55.